Right. So, ladies and gentlemen, welcome to part two of specific investment decisions. We are going to do replacement, but I just feel like I should solve this question with you so that I have this feeling that you might face a similar thing. So, let's go through it together on the lease or buy stuff. All right. Then we come back to our replacement, which is very short but boring. So, here we have Dink. The question says we have Dink. All right. And to make sure you are within screen. Let me check it out. All right. So this says that Dink Co is a small company that is finding it difficult to raise some funds to acquire a machine costing 750. The question says that Dink would ideally like a 4-year loan for a full purchase price at a before tax rate of that one alone should tells you that if we have a tax rate in the question, like it is 30%, we need to make this one post tax. And so the cost of capital must be dealt with. So we have 8.6, 1 minus t, so that would be 0.7. So 0.7 by 8.6, that gives me 6.02. So proxy, you'll be using 6%. All right. And it says that the machine would have expected useful life of 4 years. At the end of the machine, to add a residual value of 50,000. Tax savings cost for the machine would be 23,000. So we have expenditure in there. And it says that tax allowable depreciation is 25% reducing balance. That is we using buying, going to take a loan to buy. All right. Then it says that the leasing company has offered a contract whereby Ding could have used a new machine for 4 years in exchange for an annual lease payment of 200,000 at the start of each year. The contract states that the leasing company would undertake maintenance, so and no additional cost to Ding. So it means that this is a typical case of like an operating lease kind of thing, but whether operating lease or finance lease, we are not bearing it won't be part of our cost components to actually repair the thing. So it says that at the end of the 4 years, the leasing company would remove the machine from the manufacturing facility of Dink. All right. And so it looks more of operating, but you see, that is the reason why probably there is no additional expense to be made. Okay. So that is that. All right. So we have the requirements and we are told that for the new machine, we should do the present value of borrowing money, that is borrowing money to go and buy it. And we are also looking at the present value of the lease option. Then we recommend. All right. The rest is theory. The general reason why capital is rationing. So that's capital rationing, and that will be the next video that I will do. All right. So that is that for you guys on YouTube. But for my class, we've done this long time. Okay. So let's look at first of all. I would prefer you do the lease option first all the time because it is faster and before stop work, you would have done with it. So let's look at the lease option. All right, we know how we go by this. So we have our year. This thing, how many years are we leasing it for? 4 years. The asset in itself is actually like 4 years. All right. So here, since we are paying in advance, it will be 0 to 3. All right. Then there is tax. So instead of tax starting in year one, we know that it is also paid in arrears. All right. So for 4 years, will end at year 5. Something for details, rental payment, then tax relief. The cash flow, how much is the rental payment? 200,000. And what is the tax relief on that? 0.30 multiplied by 200. That is 60,000. So whilst this one is an outflow, this one is an inflow. Discount factor, we've worked to 6%. So I will just have to go and read that. All right. This page is page 196 of my book. If you want a copy, this is it. All right. After each topic, the past questions are done. All right. So don't be surprised if you meet this thing in your exam. Okay, so 6% annuity. So the zero here will be represented by 1 plus the 3-year annuity of 6%. That is 2.6673. I just have to be careful these days now, right? Then the same 6%. We are doing for 4 years, sorry. So I will do 4 years, then multiply it by 1 year backward. So for 4 years, 6% is 3.465 multiplied by 0.943. Because, like, if you really want to understand why I do it like this, or you can also pick the whole 5 years and deduct back 1 year. If you really want to understand, go and watch the video of advanced delayed annuity and perpetuity. All right, so it will help you. Okay, so here is 3.673 multiplying 200,000. So what I have here is 734 600, and it's an outflow. Then I have 60 multiplying 60,000 multiplying 3.465 multiplying 0.943. All right, so that gives me an inflow of 196,050 rounded. Okay, so my NPV will be this minus 734,600. So that gives me 538,550. All right, so basically that is what I have for that. Now let's go to we borrowing money to buy it now. All right, so where are you? Okay, so this is the ICAG one. This is the one we are doing. Okay, so now let's do our capital allowance. So 2, we are looking at the buying option. And the buying, like I explained to you in the introduction, we are borrowing money to buy. Even the lease can pass through a bank, all right? So buying capital allowance. So I told you that the question doesn't specify the timing, then it is T0 or T1, right? And the investment we are looking at, how much is the investment? 750,000. So we have tax savings or relief. Then we have timing. Okay, so the rate for capital allowance is 25%. So 0.25 by 750. This is 187,500. And we are doing this thing for how many years? To the 4th year, right? So multiply by 0.3. So I have 56,250. Timing will be what? T2. Especially in a question when the question has even said taxes in arrears. Normally, this thing is usually like that. So 750,000 minus 187,500. So I have 562,500. Tax capital allowance 0.25. That gives me 146,250. If I take that one out of 562,500, I have 421,875. So year 3, it's 4 years, so by 0.25, I have 105,468.75. And since we are rounding thing, you could have rounded this one too. All right, so that is that. Then we are told that the thing has a residual value of 50. So here, I know at the end of the year, the value of the thing is 50,000. That is that. So plus 421,875. This one is 316,406.25. So you know what to do. Minus 50,000. That gives me 266,406.25. All right, now let's do the capital allowance, the tax savings on these figures. So 140,625 by 0.3. I have 42,187.5. Then this one is a 105,468.75 by 0.3. That gives me 31640.63. And the last one, 266,406.25 by 0.3. I'm having 79921.88. All right, so basically these are the things. So you do your T3, T4, and T5. So let's set up our NPV. All right, and you remember how we do NPV, revenue, cost, and all those things. So here we have year 0, we have the years, we have 0, 1, 2, 3, 4, and because of tax delays, we have this. So let's start with net trading revenue stuff. You were told that you have this, this is for the lease, but you were told that you will spend a tax allowable service cost for, this is tax allowable. And so service cost is what you start with, service cost. And it's an outflow. Every year you are paying 23,000. 23,000 for the 4 years. And it is tax allowable. So the tax savings on this is going to be the 30% that you have, 30%, and 30% multiplied by the 23,000. So I have here 30%, 23,000. That gives me 6,900, and it is arrears, so 6,900. All right, so just so to be careful, sometimes you have to punch it again. So 36,000, 23,000. Yes, it is like that, 6,900. So 6,900, 6,900, 6,900. Don't forget the scenarios. Then we come with our usual capex. The capex is 750,000 outflow. All right, so that is that. Then your tax savings from the capital allowance computation that we have done. We have 56,250. And that should be our T2, right? 56,250. We have 41,187.5. 41,187.5. 31,640.63. 31,640.63. And the last one is what? 79. You can see that one clearly. 79,921.88. All right, so let's make our work a little bit nice. All right. Then another one is the residual value. All right, so the residual value, it will have a residual value at the end of the year. So we need to do for the residual value. All right, so that is Now, usually you have to be careful about the residual value, whether it is post-tax or it is pre-tax. When the question is silent, you have to just drop in there. What year is that? 50,000. So just drop it in there. Assume it post-tax. All right. So that is that. All right. And you have your totals here. I think at this point we can start rounding our figures. So you have this 23,000. So year 2 minus 23,000, and this gives me 40,150. Then 23,000, 6,900 for, so let's run this to 4188, or just do that. So here I'm having 26,087.7.50. So let's make it 88 here. Then the last but 1, 2. Okay. So let me round this one to 6,551 by rounding this figure. Then this one to 6,979. So let me round this one to over to 86,822. All right. Then let's go and read our discount factor. Page is page 196. Read your discount factor for 6%, 1.00. The 6%, 0.943, 0.890, 0.840, 0.792, and the last one is 0.747. All right, so that is it. All right, so what is the PVs? The value is the same here. 23. Okay, so I have 21,689. Let's put it like that. No, this one will be in bracket 4.890. That is 35,734 rounded up. All right, 26,088,840. That is 21,914. Okay, 0.6, no, 0.792 by 65,541. So this one too is 51,908. The last one is, that is 64,856. Good. So let's do the NPV. Obviously, it will be in brackets. So okay, so this is what I have. I have 597,277 rounded. Right. So comparing 597 to 538 here, what do you have? We will pick which one? 597, then 53, then we will pick the 53. So basically that is that. All right. Right. So when we go back to our page here, so that is that. So you found the answers. Okay. The question said, recommend which option is more. Oh, so we realize that the lease is more viable. All right. So that's all. Okay, so that is it. This is capital rationing. I mean, this is theory and this is theory. So do something about it yourself. Okay, so let's now go to our replacement. This is our replacement decisions. Now, if you even look at the thumbnail on the replacement, it shows you that this is not about money. It's about a question of when, timing. When should we replace an asset? Now, think about it. If I buy a laptop today, my laptop that I'm using today was bought in 2018. Okay, December. I bought it on 31st December 2018 when I went to Kumasi, my home. All right. Now, I bought it at the time. It was how much? 3,000 Ghana cedis. Yeah, it was 3,000 Ghana cedis. Now, if I'm to sell this laptop, maybe I can only sell it for how many years now? 19, 20, 21, 22, 23, 24, 25. 7 years. That's interesting. That's past its useful life. I need to start thinking of buying a new one. So, anyway, this is the Momo line. So, all right, and the Momo details are there. So you can just send it. All right, so here we are looking at, we've done the asset, we bought the asset, we did investment appraisal, we've taken either loan or a lease to buy the assets. Now the question is that when should we replace the asset? Because if you buy an asset new, I'm guessing that on that same day I could have sold it for the same amount or probably even more. But the more and more you use the asset, the more you can sell it for a lesser value. That's why the residual values are always different. They are always an amount below. All right, so that is that. So the longer you use the asset, if you use the asset now, these days my machine, the efficiency is down. So sometimes when you are watching the video, you will see some blinkings in there. It will freeze, it will do this, it will do that. The efficiency goes down. Another one is that the residual value keeps decreasing. All right, it goes down. So should we use the asset to when before replacing the asset? All right. So if you buy an asset, you use it 1-2 years, it's still efficient. You sell it, you can get a higher amount so that you can go and replace it. So we are looking at the timing of the replacement. All right. So here, the decision here is how often should the asset be replaced. So how often should we be replacing the asset? Is it after every 2 years? Is it after every 3 years? So how often? Now the formula to do that is the EAC. Okay. So don't forget, we are looking at replacement. The formula to do that is use the equivalent annual cost for that. So the equivalent annual cost, EAC, as you can see, is given by present value of all the costs. All right, then you divide it by the annuity factor. All right, so basically that is that. So the steps involved in there is that you have to do the PV. Okay, so that is that for all the costs that we are referring to, the PV. I mean, you bring them together. Then you calculate the EAC by dividing it by annuity factor. I mean, which one do you need to accept? Just as we accept the lower cost, here too, you choose the one with the lowest EAC. All right, so that is that. And that is your decision rule. But let's get through some assumption. Here, we are not interested in your cash inflows also. All right, so basically that is that. We are not interested in your cash inflows. The cash flows usually that are here are your purchase price, the purchase amount, all right, which is an outflow. The repairs and running that you'll be paying, repairs and running, all right, that is also an outflow. The only inflow perhaps will be the residual value. Okay, so basically that is that. These are your cash flows. That's all. Okay, so that is it. All right. So the inflows are ignored, all right, since they are regardless whether you buy a new machine or whatever, the thing is there. The operation efficiency of the machine will be similar with different machines, all right. That is an assumption, all right, at different age. We assume that the asset will be replace in perpetuity, or at least for a foreseeable future, that it is a replaceable asset that you can be replacing. In most cases, we ignore tax and inflation, all right? So that is that. So as with all NPVs, the non-financial aspects are also held constant, like pollution, safety, and everything. Because the more you use an asset, the more emission levy you may be paying, all right? So that is that. So like I said, these are the cash flows, the cost, all right, the operating cost, okay, and the residual value, all right? So take note of that. Tax and other incentives that you get, maybe inflation, but usually these questions don't come with inflation. All right, so basically that is that. So let's just use this example. All right, that is that. Now read this, that a special feature of the replacement problem is that it involves comparative of alternative of different time scales. Now, it says that if the choice is between replacing an item with every 2 years or every 3 years, it will be meaningless, all right, simply to compare the NPV of the two costs. And that is why we have to use the PV of the cost, all right, then we use the EAC. So basically, that is that, the annual cost, all right, and so that is that. The one that will give us an annual cost for replacing the thing. It is not difficult, but it's boring. Why is it boring? We're going to look at two illustrations, then I'll take you back to your revision question. Okay. Oh, sorry. So look at how boring this is. This is the machine, and these are the information available. So we have year 1 and year 2. So you do replacement at year 1. So replacement at year 1, or you can say within 1 year. So how will it be? So you set up your NPV analysis. You have year 0 and 1. That's it. All right. So what is the capex? The capex is that we are buying the asset at year 0, 20,000. That is it. Then for year 1, we will be spending running expense. So the running cost payable at the end of the year. The first year is what? 5,000. So this is it. You are done. So you PV it. You have a discount factor, which is 10%. So we know that this is 1 point. And by experience, you know that this one will be 0.909. Is that not it? So this is also a cost. And again, remember that there is a, what do we call it? A trading allowance, which is your residual value. The residual value for year 1, you can sell the asset for 16,000. So why not bring these ones down somewhere here? Okay. And find the difference between this one and this one. That is 11,000. I don't need to point calculator. Okay. So the net cash flows here is also 20,000. So what is the PV? Don't forget this was at 10%. So the PV is that here will be, we have 11,000 by 0.909. That is 9999. So what is the NPV minus 20,000? The NPV is that I have negative 10,001. So that is the PVs. That's the first step. All right. Then we divide it by the annuity factor. So EAC therefore will be minus 10,000, 10,001 all over the annuity factor. Annuity factor for 10% for 1 year is the same as what you have here. So you have 0.909. All right. So that is that. And how much is that? So this figure that I have divided by 0.909, that gives me 11,002. So this is how you go in to do your EAC. All right. So basically that is that. Is it difficult? No, but it is boring because you need to do the EAC for 2 years. Replacement at 2 years. So you set up your 0, 1, and 2. So the capex will come again. We had 20,000. All right. Then here you have the running cost, which means that you spend running cost of this amount, okay, for the first year, which is 5,000. You will spend it. Then because you are keeping into year 2, you will also be spending this value. Then your residual value is how much? It's 13,000. But where do we place it? Here. Please, we can't sell an asset twice. So you can't put 16,000 here. That's the only thing. All right. So apart from that, everything is smooth. Sorry, this is 5,000. And this one will be 5,500 minus 13,000. I'm doing it the other way around. So it means I have negative, no, positive. So 7,500. Discount factor at 10%, 1.00. Then this one will be 0.909. I've forgotten this one. Is this 0.856? So this, we are at page 200, right? So let's go and check. 826. All right. So multiply by 826.826. I have here 6195, 5,005.909, 4545. And this is okay. So the NPV will be plus 20K, then minus 6195, the other way around. So I'm getting 18,350. So EAC 18,350 over the annuity factor is 2 years for 10%. You can just combine these two, you will have it. But you can also read 10% for 2 years annuity. So let me combine and see. So 0.909 plus 0.826. I have 1735. So let's go and refer 1736. All right, so it's the same thing. So 0.10, 1.736. So 18,350 divided by that. That is giving me something around 10,570. So which one is cheaper? This one is cheaper. So it means we should be replacing the asset every 2 years. What is this? So that means that you say you should be replacing the asset every 2 years. So basically that is that. That is it. So it's not difficult. It's just waste your time. All right. So that is it. Okay. So pick, I guess you can try for this, but let's go to our examinable question that we started with. All right. So we have this question, and we were talking about, we did the leasing part. Then you have this part for replacement. Isn't it a good question? It is. So let's have a read of it. So it says that Melanie company is producing, a production manager estimates that if maintenance routines were upgraded, the new machine could be operated for 4 years and maintenance cost increasing 12,000 per year. Payable at the end of each year of operation. If operated for 4 years, the machine residual value will be how much? 11,000. So it means we are asked to using 10% do for both 3 years and 4 years. So replacement or replacing in year 3. All right. So your year 0, 1, 2, and 3. It's not difficult, just boring. So your capex is 160. Maintenance at 3 years, we have the information that it is 8,000 here, 8,000 here, 8,000. Then the residual at 3 years, the original one you have is 40,000, right? So this is it. This is 32. We have learned using 10% for a while, so it shouldn't be difficult. 826, and this will be 751. So here, all right, using this at 8,000, 0.3 years, that's 0.909, gives me 7272. Then 826, 8,000 gives me 6608, 32,000, 0.751 gives me 24,032. Oh no, it's positive. 24,032. These are my PVs. So if I do summation of the PV, that gives me 149,848. All right. So basically that is that EAC, therefore 149,848 over annuity factor. So you can combine these three. But let's welcome back. Let's finish this thing before the internet or even lights out gets that out. Because the internet just took me out right now. All right, so let's finish it. The annuity factor for the 3 years we were looking for before the internet misbehaved. Annuity factor for 3 years for 10%, that was 2.487. All right, so it means that my EAC using 2.487 will give me 60,253 rounded figures. All right, so now let's go and do it for the 4 years. Like I said, this thing is not another one. No, this thing is not difficult. It's just waste time, meaning the machine is due for replacement. Is that not it? Or my internet, I need to top up, right? So it's 0, 1, 2, 3, 4. We have the same capex, 160, but the maintenance changes, right? Right now, I'm even afraid. It is not writing. 12,000, 12,000, 12,000, 12,000. Okay, that's come. All right. Then the residual changes. The residual is now 11,000, right? So here you have minus 1,000, 12,000. Sorry. What will be the last one? Discount factor 10%, 621. Okay, at 4 is 683, sorry. 683. All right, so that means that by 1,000 here is 683. 12,000 and this one. That is 9010908 rounded. Then the same 12,000, let me go 826 9912. The same 12,000 with 751. It's a 9012. What is the summation of the PVs? 160,000, 10,908, 9912, 9012, 683. That is 190,515. EAC 190,515. Annuity factor 10% for 4 years. You can add from here to here, but annuity factor 10% for 4 years is 0.3.170. So the answer that I have divided by 3.170 is close, 60,099. Very, very close. But we want to pick the one that the EAC is low. So it will obviously be this one. Hey, no. This one is the lower one. It's 60,099 I have here. So that will be replacing it every 4 years. All right. So ladies and gentlemen, that is that. As for the remaining part of the question, you will see this one in the capital rationing video. We've done this, the importance of NPV superior to the IRR, theoretically the most sound one. All right, so read the theory. We've done this one. Watch the video on time value of money for Dapejan. How you go by that. All right. We have another question here. How you do this is a pure NPV analysis. All right, this is advanced NPV. We have done some of the advanced NPV, so you should be able to do this one with the videos. All right, then we also dealt with this question, all right, where there was also capital rationing. All right, and capital rationing, you need to really understand. We've solved this one too in the time value of money video. All right, so basically, there you go. Okay, so the next thing we will be looking at will be some examples of risk management. And here you have this also solved in the risk management video. The rest are theories that you have to actually deal with. We'll be looking at the public sector fintechs area. All right, so basically that is that, the public sector PEFA. All right, concept. Okay, so that is that. Then we will come to valuation. All right, so ladies and gentlemen, this is how it will go. All right, so thank you. See you in the next video. Bye-bye.